We had another broad-based advance on Wall Street today with the S&P 500 closing higher by about 0.6%. We had about 70% of the stocks within the market close in the green. The only sector that closed in the red today was the financials, where we still struggle with some of those regional banks and others involved in the banking crisis. But other than that, we are seeing some legitimate green shoots. We're going to talk about Bitcoin in tonight's video. We're going to talk about tech stocks in tonight's video. We're going to talk about emerging market stocks in tonight's video. And we're going to talk about junk bonds in tonight's video. And all of those are kind of pointing us to the direction of being more bullish than perhaps the sentiment suggests on Wall Street at the moment. We'll then get into our trade application example, where I wanted to focus on a big energy company, one that did quite well at the start of the Russia-Ukraine war breakout a year ago, but has really been languishing here over the last half of a year or so. And today seemed like a day where it was getting a little bit toppy, where it might make sense to do a bear call spread. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 30th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. Keep in mind that both David and I will have some time off here in the next couple of weeks, as both of our families have spring breaks for our kids in school. So being on our email list will be particularly useful to make sure that you're getting notified whenever we do post the videos, since some of the days we will be missing in the next couple of weeks. Nonetheless, it's a great feature also to look at the bottom of those emails and see which stocks in the S&P 500 are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow us. My handle's at Brandon Van Zee, and we would really appreciate those of you that click like and retweet on these market outlook related posts, and that way we can spread these outlook videos to a wider audience than we would be able to on our own, and we really appreciate that. In addition to that, we're heavy users of Facebook, and if you're not doing so there, we would encourage you to join our group that you see in the web address in the logo in front of you. All right, let's go ahead and jump into today's heat map here, and as you can see, we do have more green than red on the board today. It was a fairly decent rally that we were in the midst of. The market itself was up about 0.6 when it was all said and done, so not a huge day, but nonetheless, it was consistently bullish pretty much throughout the day. And so there is something to be said with that consistency. There's been a lot of chatter here lately about which stocks have been leading the market. Some of you might have seen my post on Twitter either yesterday or the day before that showed that there were 7 stocks that are responsible for all of the year-to-date gains in the S&P 500. And of course, those are the ones that we've been talking about a lot in this video here over time. Microsoft, Apple, Alphabet, Amazon, Tesla, Nvidia, and Meta. And so today it was nice to see that it wasn't just those stocks that were leading the way. We had a wide variety of stocks that were in the green. In fact, you can see Alphabet itself was in the red today. So while most of the other mega caps, kind of pulled it together for us today, Alphabet kind of sat out today's party there. But all in all, a very strong day. You will see that one of the brighter squares that shows up on our screen today is Schwab. And of course, that is a name that is of importance to many of us watching this video right now, and those of us conducting the video, myself included. While I'm not a Schwab customer at this moment, I am a customer of TD Ameritrade, and TD Ameritrade, as most of you know, has been bought out by Schwab, and so sooner rather than later, I will eventually become a customer of Schwab. And that reminds me, today we actually had about an hour-long conversation about Schwab and about some of the insurance protections that customers have of that organization, since there's been a lot more question marks about what's been going on with Schwab and kind of their role in this whole banking financial crisis that we're dealing with right now. So if you are a premium member of Market Scholars, I would invite you to check out my recording from earlier today, my Q&A session that I hold typically on Thursday mornings. But it was the worst performing stock in the S&P 500 today, down about 5%. You'll see that they weren't alone in the financial space. You also had a number of the other bigger players in the financial space down, with JP Morgan down 0.3%. Bank of America down about 1.3%, Wells Fargo down 1.5%, even Berkshire Hathaway was down 0.07%. Not much of a move there, but nonetheless in the red, while it was a green day, generally speaking, across the board. So it does seem like the financials were the area that there's still a little bit of nervousness, a little bit of stress out there. I would also say that it looks like the industrials had kind of a mixed result here today. I see a lot of red popping up there, especially some of those defense contracting companies like Raytheon, Lockheed Martin, Northrop Grumman. We also saw a little bit of a mixed result in the oil patch today, with some of these closing in the red, some of the bigger ones in the green. But, for the most part, the other sectors out there had way more green than red, and it was more of a positive day out there, all things considered. I do see that waste management had a nice day, up nearly 3%. Amazon was up a couple of percent. Eli Lilly was up 1.5%. A lot of strength over here in the semiconductor world. Intel has had a heck of a run here recently. They were up another 1.8% today. Broadcom was up 1.3%. NVIDIA was up about 1.5%. So strength there. In fact, let's see, who was this? This was Lam Research, was up 3% today. KLA 10 Core was up nearly 3%. So there has been some very robust activity in the semiconductors. In fact, in one of my recent top-down trend trading classes, we occasionally look at ETFs in addition to common stocks in that class, depending upon what's going on with the overall market. Anyway, we did look at a semiconductor-specific ETF as a trend trade here recently, as that theme has been red hot, while a lot of the other themes have fallen by the wayside. And part of that is as a result of this craze towards artificial intelligence and the chips that are going to be needed in order to fuel that advance in our society. You can see that there were also some pretty strong green squares and rectangles over here in the consumer discretionary world. We had Ford Motor, that was up about 2%. We had CarMax up about 2.6%. There's Booking.com up 1.5%. Speaking about companies we've reviewed in my top-down trend trading class, we looked at that one a while back as well, and that's been on a pretty nice uptrend here recently. We also had Caesars Entertainment. For those of you that enjoy hanging out in the casinos, it was up nearly 4% today. We had Philip Morris down here in the consumer staples world up about 2% as well. And so pretty decent day, all things considered. We've been building upon strength, and that is considered constructive, despite what seems to be still a lot of nerves in the marketplace. Let's go ahead and see what the actual breadth numbers were now. And you can see I've got the S&P 500 pulled up here under the index watch of the Thinkorswim platform, and you can see that 357 companies out of the S&P 500 were up today, and so that was good for about a 71% hit rate. So pretty strong day there, all considered. A nice healthy advance across the board. Let's go ahead and now take a look here at our 4 grid. And as you can see, we've got the S&P 500 in the upper left. We've got the Dow Jones in the upper right. We've got the NASDAQ Composite in the lower left and the Russell 2000 in the lower right. And one thing that you might notice, if you're perceptive enough, is how much different it looks today than when I was with you just 2 days ago on Tuesday. On that day, it happened to be a day when all of the postures went bearish. Now remember that NASDAQ was just weekly bearish, so as I mentioned at that time, I was still willing to give it the benefit of the doubt, especially since it was still above its moving average. But the other indices were with that darker shade of pink. And here we are just 2 days later with some pretty good rallies in the last 2 days, sending all of our postures back to bullish. In fact, 2 of the 4 are strongly bullish, and that includes the S&P 500 up here, and of course the NASDAQ Composite directly below it. Remember that it's the darker shade of green that signals a strongly bullish posture, as opposed to a lighter shade of green that would be considered weakly bullish. So the Dow Jones and the Russell 2000 also have bullish postures, but those ones are considered weakly bullish. So the strength appears to be over here on the left-hand side. And if you think about what has been driving this market recently, that should make sense, right? Those 7 names that I mentioned before, your NVIDIAs and Teslas and Amazons and Microsofts and Apples and Alphabets, etc. They are big components within both the NASDAQ composite and the S&P 500, whereas they are not big components in the Dow Jones Industrial Average, and there is 0 components of those 7 in the Russell 2000. So the Russell 2000 has not been getting the same benefit from those 7 behemoths in the market here recently, whereas these other 3 have been getting benefits from them to various degrees, but the one that it affects it the most is the NASDAQ composite. That's where you're going to find, your heftier technology types of companies. Anyway, as we look at this, you can see that not only do we have bullish postures across the board, but 3 out of these 4 charts are trading above their rising, not rising, but above their 30-day moving averages. The 30-day moving averages happen to be falling still on all 3 of those. So that would be the S&P 500. Notice the yellow line there. So it used to be red here just a couple of days ago and had been red for several weeks, but the last 2 days have been very strong and have been kind of game changers in a way to push us well above that moving average now. The Dow Jones has also pushed above it, not nearly to the same degree as the S&P 500. Today was their day where they were able to advance above it, but you're not seeing the air pocket of distance between current price and the moving average the way that you're seeing it there with the S&P 500. And then down below, the NASDAQ also has a yellow moving average right now, so that moving average is just barely declining, can barely even make it out with a naked eye, but trust the scripts, it is accurate. But price is clearly above that falling moving average. As you're looking at those, it is glaringly obvious that the NASDAQ is the one that is most likely to see that yellow moving average turn to green the soonest. And, who knows when that may happen, if it happens at all. Obviously, we've got a PCE number tomorrow. Who knows? Maybe the market acts very negatively towards that and all bets are off. But if we do have this kind of positive momentum that's been set in place continuing moving forward, it's the NASDAQ that looks the healthiest at the moment. It is the one that is likely to bend this moving average up with it, and it is the one that is most likely to break out to new highs the soonest. Now remember, this would not be yearly highs, but this chart right here, which is 3 months, you can see that just eyeballing the chart, the NASDAQ looks like it's gunning for this prior high back here on February 2nd, and it would not be entirely surprising if it takes it out. Whereas when you look at something like the Dow Jones up here, let's give it a little bit of a pat on the back for advancing over its moving average, but I don't think any of us are looking at this and saying that it's going to be taking out its high from January anytime soon. I mean, could it happen? Of course. Stocks will eventually go to all-time highs across the board, but it's a matter of when that happens, and I'm not personally expecting that anytime soon, but I'd be willing to change my mind if I see evidence of it, so we shall see there. But the NASDAQ actually looks pretty darn healthy right now. And so that's what this market has going for it. There's both good and bad towards that. It's nice that the generals of the market are the ones that are the strongest. Then again, you would also like to see the rest of the market advance along with it. Now, I don't know whether the statistics are exactly after the last couple of days, but just a couple of days ago, those 7 stocks had all of the gains and then some, and then the 493 other companies were net underwater this year. With the advance the last couple of days, I'm sure those statistics have improved a little bit. Nonetheless, if you want a broad-based advance, you want both the generals and the army moving higher together. Right now, the generals are doing it, but there's still question marks around whether the army wants to follow suit or not. So we shall see. But right now, NASDAQ composite looking mighty healthy. And that's a little bit of a surprise given where we were just a couple of weeks ago when people were, tearing their hair out over this whole banking fiasco. There's been a lot of stability that's been injected into the system since then. So Anyway, it's been interesting. This has been kind of a fun, learning environment that we've all been participating in here lately. If you enjoy becoming more educated each and every day within the markets. So anyway, that's where things stand in terms of what the actual numbers were today. S&P 500 was up 0.57%. Dow Jones Industrial Average was up 0.43%. NASDAQ Composite was today's leader. It was up 0.73%. And the Russell 2000 was once again today's laggard. It was actually down 0.18%. So despite changing its posture to weekly bullish, it was actually down on the day. It actually kind of gapped up or had a good open, but then kind of rolled over in the middle of the day. And that could be because those regional banks didn't really help the market today, right? And we have a lot of those regional banks in the Russell 2000, which is what has caused that underperformance versus these other indices. Let's go ahead and see what our 3 green arrow status says after a couple of days here. Remember when I was with you on Tuesday, none of the charts had either 3 green or 3 red, but just 2 days later, things have changed. You can see that 3 out of our 4 charts now have a 3 green arrow signal. That includes the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. We don't yet have a 3 green arrow signal on the Russell 2000, mostly because we don't have price above the moving average yet. We do have a green arrow on the MACD, and you can't really see it, but there is a green arrow down below on the stochastics as well. If I right-click and maximize that, you should be able to see it a little bit better. But we do have a green arrow in play down there on the stochastic. We do have a green arrow in play on the MACD, but we're still awaiting the 3rd green arrow on the Russell 2000, and it's got a long ways to go. I would be shocked if it happened tomorrow or even Monday. So this is a pretty big gap still between where it's trading right now and where the moving average is. But that's only one out of these 4 major indices. The other ones are already there. So again, those are some of the green shoots that are emerging. Also keep in mind we're about ready to be done with the first quarter here. Of course, tomorrow being the final day of the quarter. And it's actually been a very strong quarter for some of the major sectors and indices in different areas of the market. It's been the best quarter for a couple of years, believe it or not. Of course, that follows what was a pretty nasty 2022. So part of the move, of course, is just a little bit of a correction of perhaps too much selling late last year. Nonetheless, credit where credit's due. We've had a pretty solid rebound so far this quarter, and that usually bodes well for the rest of the year as well. Keep in mind that there is an old saying out there that many of you are probably familiar with, sell in May and go away. And usually what that is referencing is people who kind of go to cash between May and October generally avoid a lot of the market's pain over history because much, in fact, most, if not all, of the market's gains averaged out occur between November and April. So we're approaching May, but we're not yet there. And interestingly enough, April happens to be one of the market's best months. Now, keep in mind, things change because the news every single calendar year is a little bit different, but averaged out throughout history, April is actually a very strong month for the stock market. I think in some cases, in some indices, it's like the 2nd best month of the year. So who knows? Maybe we're gearing up here at the end of March with a pretty solid rally to be followed up with a strong April before additional selling takes place, maybe in that May time period. We shall see. So, it's going to be interesting to see how things shake out from that perspective as well. But what we do know at this moment, as long as there's not some sort of a catastrophic crash tomorrow, we appear to be on the verge of an extremely solid quarterly return here for the months of January, February, and March. So we'll take what we can get after having lived through ugly trading for much of 2022. All right, let's see what we've got here on our 1040 crossover method now. This will be chart 4C for those of you following along at home. Remember that these are longer term charts here, 3 years in length, with each one of the candles representing 1 week. And you can see there's a couple of thicker moving average lines on the chart, a orange one and a blue one. And as you can see in the labels above the charts, the orange line represents a 10-week moving average, exponential moving average, so that's what EMA stands for. And the blue line is a 40-week exponential moving average. And so we use this to kind of establish the idea of golden crosses versus death crosses which is fairly common parlance on Wall Street, but it's typically used on a 50-day moving average and a 200-day moving average. We do things a little bit different there, where we're using a 10-week and a 40-week, which are pretty much the equivalents when you're using a weekly candle. Nonetheless, gives us a little bit of a guide as to what's been happening from a longer-term perspective, as opposed to when we're zooming in on only 3 months like we were here just a moment ago. And from that perspective, things aren't quite as rosy, right? We do have the bullish postures across the board in the intermediate term, as I showed you a moment ago. But here on these longer term charts, we still have those bearish postures. Unfortunately, you can see the background colors of all 4 of these charts are currently pink, not green, telling us that in this case, the more sensitive orange line is below the less sensitive blue line. And so the more aggressive trading suggests that we're still struggling from kind of a longer term perspective there. But like I mentioned to you guys on Tuesday, a couple of these are really close to flipping back to bullish. The NASDAQ, I think, is gearing up for the likelihood of that, because momentum, all else being equal, will coast this market a little bit higher unless there's some other really devastating news that comes out all of a sudden. But right now, it's looking fairly likely that the NASDAQ will see a bullish crossover on the 1040 crossover method. And I had more questions about the S&P 500's ability to do that just a couple of days ago. But after the last couple of days of rally on the S&P 500, heck, it could happen there on the S&P 500 as well within a very short amount of time, saying just in the next few weeks. So let's keep our eye on that possibility. It looks like the Russell 2000 is the one that's really kind of struggling the most from this perspective. However, keep in mind the Russell 2000 did have a bullish cross for a while here earlier this year, whereas the NASDAQ did not. So you have to take that into consideration there as well. But it seems to me that those lines are kind of separating a little bit more there on the Russell 2000. In fact, you can kind of see on this PPO rank down below, when that green line is going lower, it's basically meaning that these 2 moving averages are separating away from one another. Whereas over here on the NASDAQ, notice how that green line is going up. It's telling you that these 2 moving averages are kind of pinching towards each other in that particular case. So we'll see, but I think there's a pretty decent chance that we're going to see enough momentum here recently out of the NASDAQ to actually push us to a golden cross here within the next few weeks on it. So I'll let you know if that happens to catch my eye when and if that takes place in the future. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these presentations. Many of you know that these presentations take at least 3 hours of David and I's time, and as busy business owners, we always have to question whether it's worth our 3 hours to do these videos or not. And so we know many of you enjoy them, but we don't always hear from all of you. And so the best way to let David and I know that you want us to do these videos as often as possible is by simply taking 5 seconds out of your day and clicking like. And as long as we're up and over 100 likes, I'm more than happy to do a full-length video for you. If we're under 100 likes, then I'm probably less inclined to put the 3 hours worth of effort into doing a free video out there. So in the end, we'll let you guys be the judge as to whether these are worthwhile videos in your eyes or not. All of you, of course, have the ability to be on Twitter. Not all of you will choose to be on it, but it is free. And so anybody with an internet access, which includes all of you listening to this right now, since you're listening to this on the internet, have the ability to help us if you so desire. But many of you will choose not to. That's fine as well. But for those of you that do choose to support us, we really appreciate that. And 110 of you stepped up to the plate for me the last time around, which is why I'm doing the full-length video right now. And I'll give you the same opportunity for the next time I'm scheduled to do the video, which will be next Tuesday. If we're up and over 100 likes by the time that rolls around on Tuesday, I'll be doing another full-length video there for you. Let's do some shout-outs. Thank you to Linus. Thank you to William. Thank you to Brad. Brad does a great job with a lot of real estate stuff. For those of you that don't follow him, he's quite the well-known fella over there on Seeking Alpha. I've seen him on other network television shows and things like that as well. So thanks to Brad for helping me out there. Thanks to Ken. Thanks to Milo. Thanks to Claire. Thanks to Jim. Thanks to Yair. For those of you that like CRISPR and you like biotech and gene editing, Yer is a great follow there as well. Thank you to Randy and to James and Judy and David and Naz and Barry and Sheila and John and Dean and Pamela and Victoria and Matt. I went to college with Matt, and he is a heck of a pianist, a great, great musician. And so for those of you that are looking for some nice calming music, I would encourage you to check out Matt's Twitter feed there as well. He and I go way back, but he's a great, great guy. Joel, thank you to you, and thank you to Sherry, and thank you to Jim and Greg and Carlisle and David and Jeff and Lucius and Deborah and Eugene and Nietzsche and Roger and Phil. Phil, I'll see you here in a month or so in Omaha. And Sandeep and Brian and Jayesh and BZ and Rich and Trunk. So many. I can't get to all of you here today, but I do want to acknowledge you every so often. So thank you to all of you and everybody else who took the 5 seconds out of your day to help us out there with that. All right, let's go ahead and take a look here now at our factor selector. And Factor Selector is put together on Tuesday evenings. So it's a couple of days stale by the time we're looking at it here in this Thursday video. Keep in mind that we review this immediately in my classes where it is designed to help us place our trades. And so for those of you that are premium members, of course, you'd have real-time access to it. But anyway, we can kind of get a sense of any rotation that may or may not be taking place. And to be honest with you, we didn't really see much in the way of rotation this week. Some weeks we have a big upheaval. Sometimes we get next to nothing. This week was kind of one of those next to nothing types of weeks. The only changes that we saw were in the 3-4 position there, where it was low size to momentum. And to be honest with you, I'm not really sure how long that's going to hold. In other words, I would not be surprised at all if momentum is back to 3 and low size is back to 4 next week, given what I've seen in the last couple of days. Because, again, with the regional banks having a big portion of the low size factor, those have been an area here in the last couple of days that have kind of sat out the rally, all else being equal. So I'm not so sure about that movement. I kind of get a sense that they're very, very close, and it just happened to shake out the way that it did just by the smallest of margins this week. But I wouldn't be surprised at all if they're reversed once again next week. But we do have quality leading the way for the 4th straight week. Remember, quality is where you're going to find stocks like Microsoft and Apple. They have very strong balance sheets. They have some of the highest credit ratings according to the credit rating agencies here in the United States. So if Microsoft and Apple can remain strong, there's a very good chance that the quality factor will also remain strong. And then dividend yield has been out of favor for the 2nd straight week here at the bottom. That's just not the place to be hanging out the way that it was last year. Last year, you'll recall that dividend yield was up at the top for many of the weeks because that was kind of a place to hide out while the rest of the market was suffering. This year, it's kind of the opposite. Money is flowing back to those areas that had gotten beat up a bit last year and kind of flowing out of the areas that had been holding up better last year. So it's a little bit of a role reversal that we're seeing in 2023 compared to what we witnessed in 2022. All right, let's go ahead and get back on over here to the main part of the platform now. And let's go ahead and do some 12 grid analysis, starting with chart 5A. This is asset class 12 grid. And as you can see, we got a lot of green on the chart here. Let's start in the bottom corners as we typically do with this first round of 12 grids. A reminder that the background colors are referring to what is the current posture according to the market forecast technical indicator. And so in the lower left-hand corner, you can see the US dollar is the only one that has a dark pink shading, which is kind of interesting. Some of you might have seen my tweet yesterday or last night. I can't remember exactly when it was, but maybe I could find it here real quick. It happened to catch my eye, not that I'm an expert in this field at all, since I don't spend a lot of time looking at currencies, but it was kind of interesting that there were a couple of news stories that popped up yesterday at the same time. China and Brazil have reached a deal to trade in their own currencies, ditching the US dollar as an intermediary, and China and France complete first yuan settled LNG trade, signaling the end of using the US dollar for these energy trades. So these are probably just noise, headlines at this point. In other words, just a couple of stories do not necessarily mean that there's going to be this massive upheaval out there. But I do wonder, with seeing a few more of those types of stories popping up, if that is pressuring the US dollar to a degree. Because as you can see, the US dollar here is trading near monthly lows. It's not at 3-month lows, but it's at, let's call it, month and a half lows at the moment. And it's just struggling to, kind of have some of that same robust trading activity that we were used to out of it last year. Remember, last year it was one of the bugaboos of this market where the US dollar was just too hot and it just refused to allow the stock market to go up. But you can see now that the US dollar has been kind of, on the outside looking in. The US stock market has been able to go up in that type of an environment. So don't get me wrong, I'm not complaining about the weakness in the US dollar. As somebody who owns a lot of US stocks, especially multinational ones, that actually benefits me, all else being equal. But, it is something we want to keep our eyes on because obviously the United States is one of the two major superpowers across the globe alongside of China, and there's this constant pull and tug of war of where the center of power is going to be as we head into the coming decades. And right now, of course, the United States has the advantage of being the world's reserve currency, but who knows if that will always be the case in the future. So we'll keep our eye on that. If I catch more of those types of stories in the future, I'll be sure to continue to tweet about it and let those of you that follow me kind of keep up with those stories. But dollar has been very weak, and you can see it's down again today by 0.5%. It is still with a strongly bearish intermediate posture, and we also have a red moving average, meaning that price is below a falling moving average. You can see in the opposite corner, the 10-year Treasury yield was down a touch today, not by much, but keep in mind, Treasury yields were up quite a bit over the last week, and so now they're kind of, topping out a little bit here in the short term. So you can give them a little bit of leeway there to take a breather after a pretty strong bounce after the last week or so. It's been strong enough where you'll notice that the background color of the TNX chart is now light green, telling us that we have that weekly bullish posture. But, as is the case with most charts, when we have this type of a setup and we have a weekly bullish posture, but we have a red moving average, I'm one of those that, is not too aggressive in trying to jump into that activity personally. I'd rather wait and see a little bit more stabilization there. So we shall see where that takes us, but we kind of have conflicting information on Treasury yields at the moment. And the inverse is oftentimes true with Treasury bonds themselves, and I would say that's the case with TLT. Notice that TLT was up today when we had a down Treasury yield market, and we actually bounced up nicely off of this rising moving average. So notice the opposites of those two charts. The background color is light pink up here. The background color is light green down here. The moving average color is red down here. The moving average color is green up here. And we bounced up and off on this chart, and we're bouncing down and away on this chart. So right now, I will reiterate what I mentioned on the Treasury yields when I talk about long-term Treasury bonds, saying we have conflicting information, but I kind of like the way that TLT is bouncing here. So I think in my own mind, if I were forced, I would probably prefer to be more bullish on TLT despite the bearish posture according to the market forecast technical indicator. But, truth be told, we don't really have much in the way of trend either way there. So you probably don't want to get too aggressive in any regard. In fact, perhaps TLT would be a good candidate for an iron condor at this moment in time, as it's trading basically in the middle of its trading range over the last 3 months. You can see down here on this bottom rung, gold continues to work. Gold had a very nice day. It was up 0.9%. Of course, that benefits more times than not when the dollar weakens. And so with the weakness in the US dollar, we've seen a surge in gold prices, and that started to help some of those gold mining companies as well, as we talked about here a week ago or so, whenever that was. But gold itself, the commodity, is still with that strongly bullish posture. You're trading up here near 3-month highs, and it's clearly trading well above its rising 30-day moving average, which is generally perceived bullishly. Oil, I don't think looks nearly as good, but it's possible that it could get it, some oomph and push up a little bit higher on the chart. Right now, it's sitting right on the moving average, and so I still think of this as being a critical juncture, and one that if I were a betting man, I would be betting towards the downside on oil. But obviously, I can be wrong. I've been wrong lots of times in the past, and I can promise you I'll be wrong lots of times in the future as well. In the end, everybody's just got to do the best they can with whatever their belief system is and what evidence they have in front of them at that time. But right now, given this really ugly drop in oil prices, where we clearly broke support levels across the board, followed by this very nice reversion to the mean rally, but now we're bumping our head on this moving average, I just question how much more oomph we have to the upside in oil prices, and put a pin in that conversation because it will play a role in my trade application example that I'll show you here a little bit later in the video as well. I did want to highlight that high yield bonds had a very nice day. Notice that high yield bonds are now trading here at around their 1-month highs, not 3-month highs, but 1-month highs, after back-to-back very strong days. You can see these candles here. Let me right click and show you this a little bit better. This candle and this candle, yesterday and today, very strong looking move there out of high yield bonds. Remember, that's a good sign for risk appetite, all else being equal. High yield bonds are where you typically have the junkiest corporations. That's why they have to raise money via the junk bond market. But it's a way for us to gauge the health of risk appetite out there as well. And as I've mentioned in the past, sometimes when oil prices do well, high yield bonds can do well as well, because there are a lot of junky oil companies that are part of those high yield bond indices. So that could be playing a role at this moment with the nice rally oil prices have had here in the last 2 weeks. Nonetheless, with high yield bonds, we're up above the moving average at this point and really kind of threatening some of these prior resistance areas here to the upside as well. So that probably bodes well for risk appetite across financial markets, across the board. And that kind of ties into what we've been talking about with the NASDAQ, right? The NASDAQ is kind of your biggest risk appetite from the 4 major U.S. equity indices perspective, and it's leading right now. It ties into what we've been talking about for months at this point with Bitcoin. It's been leading as well. Bitcoin was down a touch today, but it's still up here at $28,000, and that is up tremendously on a year-to-date basis. You can see that this red number off to the right-hand side here that I'm kind of circling says 69.49%. That is the return that Bitcoin has had in the last 3 months. And as you look at that number compared to all the other numbers on these other 11 charts here, nothing even comes close to Bitcoin. Now, obviously, the opposite can also be true. When it goes down much more aggressively than most of these others. Nonetheless, I think sometimes, credit where credit is due. There's been a lot of people that have tried to dogpile on Bitcoin here over time, and rightfully so in some cases. But, you also have to give it credit when it's doing well. And it's doing very well right now. And I think it's actually benefiting from the chaos in the banking world at this moment, right? With all the bank failures and everything, it's starting to have people question the soundness of money. And it's possible that some of that money will flow into alternative forms of money like Bitcoin. So anyway, I think that's a good sign for risk appetite as well. So you've got junk bonds rallying, you've got Bitcoin rallying, you've got the NASDAQ rallying, you've got emerging market stocks rallying. Those are good things. People don't want to believe in this market right now, and I understand it. I still have my own hesitations, but you also have to acknowledge the truth of what's staring us in the face right now. There are a lot of positive signs on the board that you have to at least acknowledge. Even if you don't agree with them, they are staring us in the face right there day after day. Speaking of the foreign markets here, you can see emerging markets were up 1% today, and the foreign developed stocks were up even better, 1.17% today. Both of those foreign indexes did better than the U.S. stock market. Again, that happens oftentimes when we have a falling U.S. dollar on that day, which we did here today. Also part of that story, as I mentioned on Tuesday with Alibaba and splitting itself up into 6 different companies, really kind of supercharging the performance of the emerging markets, because China is the most important country in the emerging markets, and Alibaba is probably the most important alongside Tencent, the most important companies within China. So you can kind of think about Alibaba's role within emerging markets the way that we might think about, let's say, Apple in the United States. Anyway, today was followed up with news that JD.com, which is a competitor to Alibaba and actually has ADRs traded in the United States as well under ticker symbol JD. It was up 8% here today, off of very similar news that it's looking at kind of doing some reorganizations. They probably looked at what happened to Alibaba the other day and said, hey, if Alibaba can create $30 billion out of thin air by making an announcement like that, let's go ahead and do that as well. Let's get some getting while the getting's good. And they got it all right. They were up 8% today, and now all of a sudden they're back above their moving average for the first time since going back here to the end of January. So that was probably another reason why you saw the emerging markets benefit today, in addition to the weakness in the U.S. dollar. So anyway, green shoots are out there if we're willing to look at them. They're staring us in the face. Doesn't mean that it's a one-way street to the upside either, however. There's still plenty of negative charts out there and things that we have to worry about, but it's not one-sided at the moment. This could literally break either way. It could go either bullish or bearish. There's enough evidence on the board where you can build your case on either side of that equation. Let's go ahead and now take a look here at our sectors here in the United States. This will be chart 5C for those of you following along at home. And as you can see, we've got just one chart on the board that is that dark pink color that we like to avoid if we want to be long stocks. And that is the financials. No surprise, given what we've been talking about with the weakness in the regional banks, and even when we were talking about the S&P 500 heat map here earlier in the session, and I was talking about how JP Morgan and Bank of America and Schwab and all those were down today. Well, you can see that has created some heaviness or gravity that's pushing this stock chart lower as time has gone on. And as you can see, when you're looking at the overall results of these market cap weighted sector ETFs, the financials were actually down today. They were the only one. That's kind of interesting. All the rest of the sectors were up today. Only the financials were down. And not only were they the only ones down today, they're the only ones with an intermediate bearish posture. Not only that, but strongly bearish posture. Notice that when you look at the candle of XLF today in relationship to where it is versus the moving average, it's really the only chart that looks the way that it does. The only other one that's kind of moderately in the same conversation would be real estate down below. And by the way, we had a good conversation today in my question and answer session about real estate, specifically office real estate and mall real estate, and some of these areas that have been just torched recently, and what my opinion is on whether we have a permanent change or whether it's just a temporary change in some of those dynamics. So feel free to check out that recording if you're a premium member. But real estate, as you can see, there is still a little bit of a gap between where it's trading right now versus where its falling 30-day moving average is, but it's not nearly as bad as the way it is for financials. But it's only those two. That's it. If you look at every other single chart, they're all either touching the moving average or well above the moving average. And that's yet another sign that there is bullishness out there if we're willing to admit it, right? It's staring us in the face. Look at technology. This chart looks incredible. And this is not the first time I've been bringing this up. We've been talking about technology for a few weeks at this point because remember, it's already been leading on the sector selector for a few weeks. But just take a look at this XLK chart right now. and you tell me this is bearish for the market. This is the most important sector for the U.S. stock market. It is where we have the most market cap, and therefore it is the most influential on the S&P 500. And it would be hard to say, I'm tremendously bearish on the S&P 500, and then you look at the most important sector and it looks like this. I mean, this looks like a runaway freight train to the upside. Now, obviously, all good things must come to an end, so it's not like we're expecting this to go up day after day after day, but its strength and its resilience has been breathtaking. It has been impressive, to say the least. That chart looks fantastic. You can also see that communications looks pretty decent, not nearly as good in my eyes as technology, because you still have these old highs to take out from back here. But still, you're seeing some strength out of some of those internet companies here all of a sudden as well. That's another good sign for risk appetite. When you're talking about the breakdown of these 11 different sectors here, you have your defensives on the bottom rung. Those are the areas that you don't necessarily want to see leading if you want healthy risk appetite. Instead, you want these more growth-focused areas, specifically technology, communications, and discretionary, leading the way if you are trying to establish what the risk appetite of the market is at any given moment in time. So on the whole, I think that shakes out nicely in that bull-bear debate as well, where the sectors that you want to be bullish are bullish at the moment. Obviously, the financials are a bit of an exception to that. But, if you're looking at the entire market across the board, you have to acknowledge that things are looking a lot better than what you might be thinking in your head, because we all get caught up in the horror stories, right? I was talking about that concept here in my Q&A class today, where we as humans become fascinated with the gore, right? In the news business, if it bleeds, it leads. That sort of a mindset, and you always think that the more bearish the information, the more insightful it is, and the more interesting it is, and the more useful it is. But the truth is, the stock market goes up over the long term, and much of that time that it goes up, it climbs the wall of worry. So once we acknowledge what happens regularly, yet what we are fooled by as humans quite often is the opposite, we have to ask ourselves why, right? And so that's kind of an interesting kind of philosophical conversation there as well. But I think when we look at these and we kind of take a 30,000 foot view of these charts that are staring us in the face, they don't look nearly as bad as I think the attitude and the sentiment is on Wall Street right now. Do they look perfect? No. We can put holes in all of this if we really, really wanted to. But there's a reason why we color code these charts the way that they do, and we're not manually doing that. It's happening automatically. And the reason is because that is based upon actual facts of the numbers themselves. It's not our opinions, right? If we had our opinions, we might start coloring some of these charts a different color. But we're not coloring these manually. This is happening by the computer, and the computer is telling us that according to the market forecast technical indicator and how we view the posture setting mechanism within it, there are more bullish charts in front of us at the moment than there are bearish charts. And on the whole, that's a healthy sign for risk appetite for the market at large. So I find that to be quite interesting as we wrap up what has been a pretty robust quarter for the market on the whole. All right, let's get into our trade application example now. And I'm going to pull up chart, let's do 3A. And remember, the trade application example was already done, as it always is. I always do them while the stock market is open, so that way I can get my trade filled, and that way I can send out the information to our premium members on our private Telegram channel there, so that way they can look at it and get that information before everybody else, if they so desire. Obviously, we're not here suggesting any of you take our trades. That's why we call them trade examples, application examples, right? We're not licensed advisors, so we can't tell you what to buy or to sell, but we'll be happy to show you some of our trade ideas over time, and some of them will work out nicely. Others of them might fall flat on their face. And by the way, keep your eye on LUV tomorrow. I'm actually still in that trade, believe it or not. I've had to be quite patient with it, but this patience over the last week has kind of bailed me out on that. This is an iron condor trade that we had on from a previous trade, from a previous video a couple of months back, whenever it was. And remember, this is one that was a little bit weird because I chose to do the weekly contracts, not the normal monthly contract. So tomorrow is actually the expiration day on this iron condor. I am likely going to be trying to get out of it probably in the morning if I can help it. And if I do, I will be sure to let you guys know in the Telegram channel, those of you that are private members or premium members of our organization. So keep your eye on that possibility. But if you happen to have this trade on still as well, just be aware this is your warning or your disclosure that tomorrow is the final day of that of those contracts, and you'll want to take care of your trade one way or another. But right now, we're right there neck and neck with whether we're going to end up making a profit on it or not. Above the blue line, we have a decent chance of making a profit. Below the blue line, then we're probably going to have to lock in a small loss. But regardless, I'm glad I didn't bail on the trade a week ago, and I allowed this thing to bounce back nicely. I feel like I got pretty darn lucky on that. It was not my skill that did that. It was luck that the market's been pretty strong here in the last week, and I was willing to be patient with it. So anyway, keep your eye on that. Normally, I'm not going to bring up a past trade on a weekly contract like this, but because of the peculiarness of this one, and it's not a monthly contract when most people are thinking about the expiration cycle, wanted to bring that up here quickly with you guys as well. But let's talk about our actual trade idea for this video here tonight. What I'm going to bring up here is ConocoPhillips. So what I did in this case was I sold a bear call spread on it. And I believe what I did was the April 105, 106 call spread. So anyway, it was a $1 wide. And you can see that 105 is approximately right in this area. We got 30% return on risk on it, so it was like a 24-cent credit on a $1 wide vertical. And so our break even would be right around where my mouse is right here, just to give you a visual of that. Now, what I did in this case is I did the April contracts. And so be aware that, it's a little bit different than how I normally would have done it. At this point, with the Mays having 50 days until expiration, my preference would have been to go out to the Mays. But as most of you are aware, we're going to be kicking off earnings season here very shortly. And in this particular case, I opted to go a little bit tighter on where my break even would be compared to May, simply because I would prefer to be out of the trade before earnings if I can help it. I don't handle all vertical spreads that way, but if I can get away with it, I would prefer to do it that way. So in this case, we're going to be in this one for a lot shorter amount of time than the typical credit spreads that I show you guys in these videos. These are the April contracts that will be expiring here in just like 3 weeks. And so that's why this looks pretty tight from right here to where the stock is trading right now. This one is likely to report earnings on about May 2nd, because the last earnings were here on February 2nd, so 3 months later, somewhere around that first week of May is when I would anticipate when they'll come out with their earnings. So we should be out of this trade one way or another before they report their earnings. And so this one kind of caught my eye today. I mentioned before what was going on with oil prices, right? So here's what CL looks like, and we also looked at USO as kind of a proxy in the ETF world, where they're both kind of butting their heads up here against that falling moving average. And so naturally there's going to be a lot of individual oil companies that will kind of follow suit with the commodity itself. And Conoco kind of strikes me as it's in that general vicinity where you've had this reversion to the mean move back towards this falling 30-day moving average. But as of right now, it's looking like there's a decent chance that it's going to reject that area, right? Today, the market was up nicely. Remember, all sectors were up today except for the financials. That includes the energy sector was up today, yet Conoco was down 0.5%. So there was underperformance versus the market today, and that's not anything particularly new. You'll notice up at the top of the chart, Conoco is down 15% this year. It's down 6% this month. It's down 13% in the last 3 months, and it's down 2% in the last 6 months. So in other words, for the last half a year, it's been a tough go of things for ConocoPhillips. A year ago, different story, because that's when oil prices started to really perk up with the Russia-Ukraine thing, and so you still have some gains from that time, but it's given back a pretty decent chunk of those initial gains from a year ago, and it's been stuck in this downward slide ever since. You can see it's woefully underperformed the S&P 500's dotted line way up here. That separation started to occur way back here at the end of January. So this is not new information. We just have our most recent reversion to the mean type of a move. But if it's anything like this reversion to the mean or this reversion to the mean, then it's eventually led to lower prices. And so we shall see if that takes place again, but you'll notice that today was the day where the background color went from blue back to pink because this blue near-term line fell out of the upper reversal zone and give us a little bit of bearishness there once again. Remember, I use that blue line on swing trade types of ideas a bit more, and with this one being in the trade for only 3 weeks because the April contracts will expire so quickly, it kind of fits that mold of more of a swing trade as opposed to more of a trend trade. So that was kind of the idea behind this. Weakness today versus the market, weakness today versus its sector, weakness versus the market really for the last half of a year, and clearly having a hard time getting back above its moving average. And with it kind of selling off today at a higher point here, it makes you wonder if this is going to set off yet another string of selling moving forward. And if it doesn't, if this thing just rockets higher, well, remember the benefit of having a bear call spread like this is the driver of the trade is the sold call of 105, but I also own a 106 call as part of that vertical spread. And that is there as an embedded hedge. So if this thing were to rocket higher here for the next 3 weeks, I would not lose incrementally more money the higher it went above 106. So that's nice because we have defined risk with this trade as well if we're wrong on it. If we're right, which of course is what we hope, then we can make our 30% return on risk, which is what we typically shoot for with these credit spreads. Okay, so that's what I had for you here tonight. I hope you enjoyed the video. If you did, I have one simple request. It doesn't cost you a single penny. It doesn't cost you your firstborn or your left arm or anything that is too difficult for you. All it costs you is 5 seconds of your time, and that is simply click like for us there on Twitter. That goes a long way for David and I. We really, really appreciate that. As long as we're up and over 100 likes, by the time I'm scheduled to do the video again on Tuesday, I'll be happy to do another full-length video for you at that time. On the other hand, if you prefer a shorter 15-minute version video of the video, with no application example and extras like the 12 grids, then feel free not to click like. And if we're under 100 likes, then I'll just make sure that it's nice and short next week. But again, I'll remind you that David will be out of the office for most of next week. So next week might be a week where you want to hear more from me, not less. So keep that in the back of your mind there as well. Whatever you decide, I appreciate you checking out tonight's video, and I will wish you all well. David should be with you tomorrow, but I hope you all enjoy the Final Four this weekend. I know I will. Congrats to all of you that have a horse in the race still. It should be a fun one, quite a hodgepodge of Final Four teams this year. You don't have your traditional blue bloods like you expect, but that'll make it a little bit more exciting as well. Who knows? Maybe the national champion will be a school called Florida Atlantic University. Wouldn't that be something? So we shall see, but enjoy that if you're going to be watching it on Saturday as well. Until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.